Today we're going to be talking all about rental income.
Rental income is an interesting tool that a lot of people don't really understand how they can maximize the utilization of it. So we wanted to make a video today outlining the advantages and disadvantages of some types of add backs and offsets and how you can use it to your advantage to scale your portfolio.
I've seen people qualify for $400,000 on the A side, and then we take them to the B side and their qualification's $800,000, $750,000.
Wow.
So it's a huge difference if you're really looking to maximize your potential takeout. So in a situation where you're looking at a BRRRR where maybe you can afford the purchase on the A side, but the refinance you're gonna have to do on the B side, you're gonna have this huge increase in value. That can be a good play there to be able to potentially afford the refinance and take out that equity.
What's going on YouTube? It's Lynn Matheson here, aka the Canadian Cottage Girl, and we're on an episode of the Findlay Finance Friday, and today we're going to be talking all about rental incomes. How's it going, guys?
Doing well, thanks for having us.
Yeah, absolutely. Welcome to the channel. Let's get right into it. So let's really break down each different type of rental income and how that works in terms of qualifying for more mortgages or how you can continue to expand your portfolio.
Sure, yeah, thanks so much for having us again. Rental income is an interesting tool that a lot of people don't really understand how they can maximize the utilization of it. So we wanted to make a video today outlining the advantages and disadvantages of some types of add backs and offsets and how you can use it to your advantage to scale your portfolio. So the very first one we wanted to talk about, which is the most commonly used, is the add back. The majority of conventional A banks use an add back, which essentially means they'll take a portion of the rental income, usually 50% of it, and they'll add it back to your gross income, and then you'll have to qualify for the mortgage you're looking to get. They can use that for subject and non-subject rental properties, essentially meaning the properties that you currently own as well as the property you're looking to purchase. So if you don't have rental actual leases in place for the subject property, which is the property you're looking to purchase, we can use a fair market rent report and use 50% of that rent to add to your gross income. So even though you have a vacant possession, we can still utilize that rental income to help qualify. Now, as many of you know, the banks cap you out eventually depending on how much income you can show on your T1 General, which can be a challenge for most people. So we decided to take a look at how this might be advantageous for the first few, and then what solutions are available in the market after that. So the 50% add back is the most commonly used add back that most banks use. The majority of the time, if you have about double of your mortgage payment, it can offset the majority of the cost of your actual mortgage that you have on the property at the time. This allows you to scale to a certain amount, but kind of hit a cap after that.
Yeah, so the second type of rental usage we want to look at is the rental offset, and this becomes very prominent when we look at our B-side lenders, and this is really how we can help investors scale beyond where the A lenders can let us get to. So an offset really takes a look at utilizing the rental income and actually offsetting the cost of that property. Now the most common offsets that we're going to see is either 50% of the rental income, that's on the A side for our A lenders, and then up to 80% and sometimes even 100% on the B side depending on which lender we go to. So take a look at that, 50%. So if you're getting $2,000 a month of rent a month, we're going to use $1,000 of that, $12,000 over that year. We're going to take that $12,000 and we're actually going to mitigate that against all your housing costs, so your property taxes, your condo fees, 50% if you have condo fees, and your principal and interest payment, and we're going to reduce the amount of qualifying expenses that you have. On the B side, same thing. We're going to take 80% of that. So again, if you're using $2,000, $1,600, take that over the year, deduct that against your expenses, and to mitigate your qualifying expenses. And this is really important because the most effective way to increase your affordability on an application is actually reducing the amount of expenses that you're qualifying with. As everyone should know by now that how we qualify is based off your debt ratios and your income to debt, and reducing that drastically increases how much extra income you have left to be able to allocate directly towards your mortgage. So offsetting is one of the most effective ways to really decrease your debt ratios and increase the way that you can qualify. And then if you want to take it a step further on the B side, we are able to extend those ratios out much further than what we can on the A side. So it really is a bit of a twofold effect there, and really does increase the affordability.
Absolutely. It sounds like, so the difference is basically 50 to 80% of what you're able to account for in that rental income, and that's both potential rental income, as Josh said, as well as your current rental income in any properties that you have right now. So it sounds like there's a really good opportunity to even qualify for more on the B side for sure if you're trying to offset those costs. And with that A side as well, just to go back to a few points that you made there, Josh, just with that rental income offset, when you're qualifying, you mentioned a cap. So what is the typical cap that people get to, or what's that sticking point on the A side that maybe we should start looking at the B side in utilizing a better debt to service ratio and offsetting a little bit more of that rental income?
Sure. So I mean, your cap on the A side is based off of your GDS and TDS ratios. So essentially, how much income do you have compared to how much debt do you have? Most banks are about 39% and 44% with relaxed ratios, meaning if your credit score is above 680, we can use 39% of your total gross annual household income for expenses that have to do with owning property, and then 44% with expenses that have to do with owning property, as well as any outside expense, car payments, student loans, lines of credit. And if you fit within those ratios, then a lender will allow you to be able to qualify for that debt. And that's where essentially when we start hitting those maximum ratios, we have to start utilizing different ways to maximize your rental offset or add back. Now, something to keep in mind is that offsets aren't necessarily always for B lenders. So there are some A lenders out there that will use an offset. You'll sometimes hear people talk about certain banks that will use a 50% offset instead of an add back, and that's why these certain banks are situated where most investors are investor-friendly banks, and they'll go to them because you can probably get 5 or 7 of these properties depending on how much you actually show. These types of offsets are really advantageous for somebody who is a business for self, or somebody who doesn't necessarily show a lot of T1 income and has a high cash flowing rental portfolio, because it allows you to be able to scale without necessarily needing to pay a large amount of personal tax.
Right, that makes a lot of sense. And as we're continuing to grow up and scale, this sounds like it's very important. Is this something that, as a first-time investor, someone should be concerned with, or is this more like 4, 5, 6 properties down the line?
Yeah, it really depends on where they are with their qualification and how much income you're showing. Obviously on the A side, we're limited to how many properties we can have in a portfolio, but when we're taking a look at effectively using that rental income, someone could have 1 property and show less income and be maxed out on their debt ratios. Someone could have 6 properties on the A side and be maxed out on their debt ratio. So it really comes down to how much income we're showing, and like Josh said, for business for self individuals who may show less with write-downs, they may be into the B side quicker for quite a few reasons, but versus someone who shows maybe a $200,000 T4 income, they're going to be able to debt service on the A side maybe up to their 5th, 6th property without any issues, and then have to take a look to switching on the B side. So there isn't really a specific situation, but it really just comes down to the debt ratios and how much income you're showing and what your debt takes a look at. And the offset, like I said, it really just applies to the property cost. So there are some external factors. Do you have car payments? What are your credit cards and lines of credit and student debt like as well too? Because that other debt does come into factor as well. So again, you could have a high income, high debt, and need to move on to the rental offsetting side much quicker. So it really depends on the debt ratios. They really are the main factor.
Yeah, I think if you're a first-time investor, a good benchmark to have would be you want to have your rental income double what your mortgage payment is, because if you take 50% of your rental income, it offsets your mortgage payment, and that'll allow you to kind of wash the property and scale to purchase another property without having to take on that debt. So as a benchmark, I would say if you're looking to either refinance, make sure that your mortgage payment isn't over 50% of the total income you're making per month on the property.
Awesome. I really like that from a napkin math perspective, is just taking a quick assessment of what the average incomes are in the area for rental properties, or maybe what it's already bringing in. And as long as that covers, you said 50% of your cost or total cost of the mortgage, then we can absolutely move forward on that property and grow and scale quite quickly. Okay, great. Well, let's break down surplus debt now a little bit further. And just to kind of build off of offsetting, this is another great way that you can absolutely just continue to expand your portfolio. So let's break this down in more detail.
For sure, yeah. So surplus deficit calculator is individual to the bank. So each bank has their own spreadsheet, what you would say or call it, and they have their own way in which they go about looking at rental properties. So some lenders will use up to 80% of your rental income, and then they will deduct your fixed costs, so your mortgage payment and your property taxes, and if you have condo fees, part of your condo fees. Now, what happens is if there is a surplus after the expenses are taken off of your rental income per month, then you can add that to your monthly income, and it increases your total amount of income that you can qualify for your loan, which can be really advantageous if you have a handful of properties that are in a surplus. Now, if you have a property that isn't necessarily operating at a high enough level and you're in a deficit, we have to add that monthly payment to your liability section, which obviously doesn't necessarily help you in a sense, but if you have 6 properties per se and 5 of them are doing really well, then it just kind of plays out and levels out. Using the surplus deficit calculator is a great way to scale, specifically because you can focus on individual properties, and if you have a higher cash flowing portfolio, it's going to allow you to be able to purchase more properties than maybe if you used a 50% add back. And this is individual to the lenders, so not all lenders offer this type of rentals calculation, so it's really going to depend on the broker you use and which banks that they use, and that's going to allow you to be able to scale and purchase additional property.
Absolutely.
Yeah, and I think, like, to touch on a little bit further and why it actually does help you scale is because once we've done that surplus deficit, we actually remove all the costs of the property from the application. So we essentially don't have a property on the application, we have either just additional income or a bit of a liability. So we're not adding a liability and calculating all the costs on the property, we are removing that property from the application. So it does have a pretty effective way. And one of our A lenders that we work with does allow you to use 80% of that rental income and do the offset. So it is your highest usage of rental income on the A side from that standpoint. And they actually do allow you to go up to a pretty high amount of properties. You can get up to 10 properties with them. So it's an effective way to be able to maximize, like Josh said, your rental income and utilize that. The surplus and deficit is really just used on the non-subject properties. It isn't really used on the actual subject property. Usually you're going to have an add back or some sort of offset on the subject, but for your non-subject properties, we can essentially wash them off the application, and it does have quite a good effect on your debt ratios.
Yeah, that sounds huge. Like that can be a game changer for actually qualifying for a property. And now we've broken down a few different ways to actually offset and potentially get into another property, but let's actually break down some numbers and some examples just to really understand how this would work in real life, in real application, because it sounds like this is such a great way just to grow and scale. And also another reason why it's so important to have the right mortgage agent that you're working with, because just to navigate all of this as an investor yourself, A, watch more Findlay Finance Fridays, but B, really understanding the nuances of which banks will actually account for those surpluses or account for 50 versus 80% of the income is really important. And if you go to one bank and they say no, you can absolutely continue to break down your portfolio and grow even after getting a no with another bank by going through the right people. So I'd love to break down some examples of what you guys have seen or just some real world kind of challenges.
Sure, I think that's a great point that you just made is the majority, if you're working with a broker who just adds 50% back to your gross income and they say, no, you can't qualify, you have to go to a B lender, that can be an extremely expensive situation that you're in. You have a broker fee, you have a lender fee, you have additional rate increases. There's a handful of things that would cost you additionally that you might not have to actually take into consideration or actually use. So make sure you're looking at all your options, because there are so many banks out there, and it's not just the big 5 banks. There are monoline lenders, there are other niche banks that specifically focus on helping investors grow. So if you get a no right away, it's might not always just be a no, so just make sure you're looking at all your options.
Yeah, definitely. And then in terms of the example, just some basic numbers here. So we're going to use $2,000 a month of rental income, property expenses, just from the example I'd written down, $28,042, it's a random number, and that $28,042 takes a look at your property taxes, if you had condo fees, 50%, and then your principal and interest payment. So when we take a look at 50% of that $2,000, that gives us $12,000 over the year. So if you take a look at, deducting that $12,000, instead of qualifying with $28,000 in change, now we're qualifying with $16,000 in change. So you're looking at $12,000 reduction in that expenses. 80% if we're working on the B side, all of a sudden now we're using $19,200 of deductions, which drops your qualifying expenses down to about $8,000. So there's a huge reduction there when we're taking a look at how much income you have to allocate to that debt. Now you're able to allocate an additional almost $20,000 towards your actual annual mortgage payment and allowing you to qualify that way. So it's a huge boost to be able to really reduce those expenses. And taking it even further, if you have enough rental income where you have enough to cover all the costs of the property and have some left over, you can add that back to your income as well too. So let's say you have a property that's giving you $4,000 a month, you're getting $48,000 a year. You take 80% of that on the B side, and you're reducing that same $28,000 of expenses by $38,000 roughly. That leaves you with a surplus of $10,000 in change. So now we have essentially written off all the costs of the property or offset of the cost of the property, and we're adding $10,800 back to your qualifying income. Not only are we reducing your expenses, but we're also adding more income to be able to lower that ratio as well. And then again, going back to the fact that on the B side, we can bring those ratios to 50, even 55%. I've seen people qualify for $400,000 on the A side, and then we take them to the B side, and their qualification's $800,000, $750,000. Wow. So it's a huge difference if you're really looking to maximize your potential takeout. So in a situation where you're looking at a BRRRR, where maybe you can afford the purchase on the A side, but the refinance you're gonna have to do on the B side, you're gonna have this huge increase in value. That can be a good play there to be able to potentially afford the refinance and take out that equity.
Absolutely. Yeah, I think that those are really good points just in terms of practical application and just seeing those little differences, just the way that you refinance it, just the way that you actually account for the rental income, make a huge difference in the long run. And when we actually account for a potential surplus of $10,000, that's really contributing towards building your portfolio and actually getting the most out of that independent properties. So I think that this is so important and something that a lot of people probably aren't taking into account when they're looking at these properties. So thanks for the breakdown, guys. Any other points about this offset or how we can kind of improve the application?
Sure, yeah. I mean, when you take a look at your portfolio, everybody's is different. So we have some clients who have primarily properties in secondary markets, and those markets have high cash flow. And then we have clients who have mixed portfolios. So say you have a bunch of condos downtown Toronto, but you also have some other properties that are doing really well. Well, I have clients who are looking to utilize the rental income, but if you have properties usually in downtown Toronto that don't cash flow, that can negatively affect your ability to be able to purchase property or refinance or restructure property. So just like a real world example, I have a client, he's got about 7 properties. 3 of them are in Toronto, the rest of them are in secondary markets, Windsor, Sarnia, Chatham. And the Windsor, Sarnia, and Chatham properties cash flow really well. So if you did a 50% add back, it would help him. It'd be advantageous, he could go and purchase more properties, but because he has these condos in Toronto with high condo fees, it puts him in a deficit situation. So all of the income or the additional surplus that he had is essentially being negated because of his other properties in Toronto. So what we did was we actually took a look at the 80% add back from an A lender, and we were able to use the income in a different way, and that actually allowed him to be able to purchase another property where he necessarily wouldn't have been able to previously. So again, just understanding how your portfolio works. If you have a deficit on some properties and it's affecting your ability to purchase, maybe that's just not the right lender. So understanding what lenders allow, working with a broker that can take a look and understand what options are out there is huge, and it's going to allow you to be able to scale.
Love that. Awesome, guys. Well, thanks for coming on to another episode of the Findlay Finance Friday. If you liked this video, make sure you like and subscribe down below, and also hop over to the Findlay Team channel, and they have full breakdowns of all of their videos about mortgages, how to qualify, and so much more fantastic content. So really make sure that you like and subscribe down below if you liked today's video, and hop over to their channel and check out some of their great content as well.